On September 8th, when Marvell stock price crashed, I made a video and highlighted that I thought it was a buying opportunity. And since then, the stock price is up over 30% in less than 1 month, or a little over 1 month, depending on when you're watching this video. But investors are asking me now, what do I think about Marvell? What's going on with the company? Do I still think it's a buy, or is it time to downgrade this business? Let's take a look at the latest developments.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So like I mentioned in the introduction of the video, on September 8th, I upgraded Marvell stock to a buy. When everybody else was selling this business, I saw an opportunity. And since this upgrade, the share price is up over 30%. So congratulations to those of you that got in at those attractive valuations. But let's take a look at the company and what's been going on lately according to the management team's discussion about their latest quarterly performance. So Marvell's management team said that they delivered record revenue of 2.006 billion, which was a 6% increase from the previous quarter, but more importantly, it was a 58% increase from the same quarter last year. The company is benefiting from the rising demand in artificial intelligence. The company's data center end market continued its strong momentum, growing 69% year over year, fueled by robust AI demand. Marvell is competing in the data center industry optimized for artificial intelligence, and one of its main competitors is Broadcom, which has also seen its share price soar in recent months. They saw a solid recovery in their enterprise networking and carrier infrastructure end markets, which collectively grew 43%. They expanded their operating margin to 34.8%, and they delivered record non-GAAP earnings per share of 67 cents, which is up 123% year over year. The company also generated $462 million in operating cash flow. If you take this operating cash flow and you divide it by the sales figure we saw earlier of $2 billion, the company generates almost 25% operating cash flow to sales ratio, which is a nice number, especially for a company that's in the middle of a significant growth surge. That's up significantly from their $333 million they generated just in the previous quarter, so an increase of $130 million just quarter over quarter. And the company is using this cash flow to repurchase stock. They bought back $540 million of stock in the first half of the year, with $2 billion remaining in their authorization. And given they just recently divested their automotive Ethernet business and got $2.5 billion in that all-cash transaction, that's going to give the company more cash to continue driving this stock price repurchase, as what management is saying. And that's what has investors really excited. They like when a company is generating cash flow from sales and from an increase in demand, and using that cash flow to return capital to shareholders. Investors get less excited when a business is booming, but the business has to use a lot of that capital to reinvest in the business to capitalize on that growth. There's something similar going on with a company like Oracle. Oracle's business is booming, but Oracle's having to use a lot of the cash flow they're generating and then some to reinvest in the business so that they can have the capacity to serve the customer orders that are coming in. Investors get more excited when there's a boom in your business and you can serve that boom with existing infrastructure, no longer needing to reinvest and grow the business, grow the assets in order to serve that business. Think of a company like Netflix, right? Netflix has been booming, and Netflix doesn't need to create more assets when it gets an increase in subscribers. The company already has the content, and if more subscribers come on board, they can watch existing content. Whereas a company like Oracle, when it gets orders for more infrastructure, they need to invest to build that infrastructure to serve those orders. That's a less exciting investment for investors. They like when businesses can serve increasing demand with existing infrastructure. That's partly why investors are excited about Marvell Technology. So One of the reasons why I upgraded Marvell stock to a buy on September 8th, as I mentioned, is my proprietary discounted cash flow valuation model identified the business as being undervalued. Well, now that the share price has soared all the way up to $87 per share, the intrinsic value per share, which I updated this morning and increased the value, is still not enough of an increase to make the stock undervalued following this big share price increase. So the stock now looks overvalued even after I account for a margin of safety, even after I accounted for an increase in expected free cash flow as a result of this boom in business in recent months. So the stock now looks overvalued. And so those of you that got in at those lower valuations, congratulations. But that these new higher valuations, I think the stock is now a hold. I no longer think it's a buy. And I'm updating that recommendation today, October 7th, 2025. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.